Very happy to welcome you in this panel. The topic of the first panel is, as always, on the situation for monetary policy, not like the next day, but the medium perspective, namely how to get inflation back to target. And there are related issues such as quantitative tightening, which is the operating procedure, operating system of monetary policy, but maybe also some financial stability questions which may come up. So I'm delighted to welcome Philip Lane, Monika, Merz, and Michael Bordo. Thank you for agreeing to join us here today. I'll keep introductions very short. First, starting with Philip Lane. Oh, and by the way, when we present, or when you present, I think it's easiest if the speaker presents from over there. I mean, if you'd rather remain seated, but I think it's better in terms of the microphones, and you will have a bigger picture there to look at if you use slides to see the slides. So we'll start with Philip Lane. Philip, it's great to be able to interact with you also in this series. Philip, of course, is well known to you. He's, I could go back to his academic achievements, but it's also important, he actually has been on the Governing Council since 2015, first as governor of the Central Bank of Ireland, and then here as chief economist. So now he has a long experience both of the low interest rate period, but now the rapid rise, the change in dimension. So Philip, I think I will keep it at that. We're of course going to be very keen to hear your assessments. There's also been a big change compared to last year. I'm glad we're all here today physically. That's a great possibility to interact. Let me also introduce your other panelists quickly so that we can go in terms of the presentations right away, step by step. So next up we will have Monika Merz. Monika Merz is an academic. She holds a PhD from Northwestern University. She was a professor at Rice University, at University of Bonn, and also now the University of Vienna. Actually, currently you're on leave in Rome, so you flew in from beautiful Rome. And at least there's sun here today, so that's good. Maybe you brought it along, I don't know. But in any case, Monika is also an expert on labor markets. She's a macroeconomist, but also an expert on labor markets, has worked on search theory, and President Lagarde already brought up the question of wages, underlying inflation. So we'll be keen to hear your viewpoints and analysis. Then we'll go on to Michael Bordo. Michael Bordo, I didn't fully know that, but you have actually Canadian roots, and but are an American, are in the US for a long time, but you started out at McGill University, you got your PhD from Chicago, and you've been a professor in a number of places in the US, most recently at Rutgers University, and a fellow, visiting fellow at the Hoover Institution. I think what's going to be particularly interesting, I mean, as you know, Michael Bordo is an expert also in not just macroeconomics and multi-economics, but also economic history. And so we're keen to see what you will be able to tell us, both in terms of a comparative analysis, the situation in the US and here in the Euro area, but also in terms of a broader historical view. I mean, many of us have looked at the past, again, when presented both with such an unusual development on the inflation front, but also what's happening now again in the banking system. So I think we're up for an interesting exchange. Philip, over to you. Thank you, and we'll start with your analysis and presentation.
Thank you, Volker, and thank you for organizing this event. I think it's a fixture on the calendar. It's a very important fixture on the calendar, and I look forward to the panel discussion and to meeting many of you later on. Let me say that my plan today is essentially to also follow this basic triple step approach to understanding the inflation challenge we face and the monetary policy response. So for me today, step one is really to go through the elements of the most recent staff projections that came out last week. So yes, they were finished before the current financial volatility, but it's still an important baseline as a starting point. Next, I will cross-check between what the forecast implies and what we're seeing in the actual data in relation especially to underlying inflation. And then the third component will be to look at the transmission of monetary policy, which as the President already indicated, it's very much in stage one, the transmission of our policy rates to various parts of the financial system, whereas part two, the impact on the real economy, it is going on, but in the hard data, not so much yet. Okay, so let me start with the projections, and let me maybe focus on the bottom panel, which is the Q4. This has the advantage of it avoids carryover effects. It's basically from the end of last year towards the end of this year, what is the net increase in GDP, the net increase in the price level, whereas the annual averages, you do have carryover effects to think about. And as Volker mentioned in the introduction, 2022, and again, this is Q4, not December, but it was double-digit inflation. We had 10% inflation in 22. And of course, this is just so far above where we would like it to be. And then what we have then is, over the course of this year, a very large disinflation over the course of this year. But of course, this is only Q1. So by the end of this year, inflation is projected to be in the high twos. Next year, it's essentially, which I'll come to various reasons why, it's essentially moved sideways and then returns to 2% in 25. And for GDP, what we have is essentially a growth rate this year, which looks better than it did in December because of the easing of the terms of trade shock. But in fact, later on in the horizon, there has been some downgrade in 24 because of the monetary tightening. And I'll come to other components later on. So maybe one way to think about what's happening is to compare what we think now compared to what we thought in December 21. So in December 21, which is the dotted blue line, what we had is essentially a projection saying the bottlenecks are going to ease. The pandemic is going to be over at some point. And given the kind of halt in activity during the pandemic, what we would expect is a pretty strong recovery. So in 22, an ongoing, a pretty strong recovery. And then since then, with the war and the terms of trade shock, whether it's in December or in March, we basically do have a recovery, but a much lower increase, cumulative increase in GDP. So we have a much flatter profile for GDP than we thought just over a year ago. And that reflects the terms of trade shock. It reflects the demand effects of that terms of trade shock, where there is this lower path. Now, it's slightly better than in December because the terms of trade shock has eased, but it's nowhere near the pathway we expected in December 21. And again, there is, to some degree, a downgrade in potential output, but a lot of this is a downgrade in the demand response to the situation. And you see that in the individual profiles of consumption and investment, so the domestic components of overall activity. And compared to what we had in December 21, again, it's a lot shallower, a lot flatter than we had at that point. And let me highlight that's particularly true in this year, moving from 22 to 23, especially for investment. So another way to say that is essentially, I think one of the common themes is, how can you have disinflation in an economy that's growing? And one of the basic points here is the growth projection we have now is just so much less than we had before the war. So a period of disappointing levels of demand in this year especially, and also to some extent last year, is essentially contributing to the slack, if you like, compared to what we had expected before the war. Okay, let me turn to inflation and the components of inflation. And this is what's basically in the projection. And what you see is essentially a diagnosis that what we saw is this extraordinary shock in inflation. And what we are entering is a phase where some of this will fade away, basically through base effects, doing a lot of work. And so you do have this very sharp and much sharper than we had for energy than we had in December. So energy inflation hit the mid-30s, and then it's coming down basically to around zero for this year, on average this year. And in fact, below zero, energy deflation later this year. What's important, and again, when you think about annual averages, is for food and for core, in fact, the peak is this year, not last year. So we do have this handover, this transition in terms of the nature of inflation, is that on an annual average basis, there remains momentum in food inflation and core inflation, at least for part of this year. So this is important in understanding the diagnostics of the inflation process. And another way to express that on the left is essentially the contributors to inflation are moving. So we saw last year this very large direct energy component, which is basically not going to play a role now. The green box plays a little bit of a role in 24, because there is a presumption here that various fiscal subsidies that have been important will be lifted next year, and therefore energy prices which have been suppressed by subsidies, when those subsidies get removed, and the modelling suggests that's going to be important next year, will lift up inflation again next year. And that's why in 24 we do have this sideways movement because of that lifting of the subsidies. But what you see is essentially a bigger role for core, and you see this year a very big role for food. And food is 20% of the index, so it's pretty important. Let me talk about the spillover from energy and the exchange rate, for that matter, to core on the right side. Now, there's many ways to think about the spillover of energy to core inflation. In many of my speeches, I've gone through many different calculations. So this is just one, but it's based on the BMEs from the models that are maintained by the national central banks. And what it tells you, and the solid blue line is our current assessment of this. And it's very important to recognise this, that the models have a lot of lags in them. So even though now energy prices have turned around, the energy increases that happened last year are still modelled to be pushing up inflation for quite a while. So what we have here is that right now in Q1, on overall terms, the combined effect of the exchange rate and energy is adding 1 percentage point to core. So again, yes, there are sticky parts of core, but there are also these factors which over time will fade. So here we have essentially, if you track that solid blue line, it goes from 1% now to 0 by the end of the projection horizon. So over these years, again, we can have some disinflation in core, even with kind of no adjustment in monetary policy, if you like, coming from that factor. There's still, core, even subtracting 1 percentage point is still pretty high. So it's only one factor, but it's important to recognize, to understand these dynamics. So what I show here also has the gross components, that yes, we do think the fall in energy prices is holding back inflation. We do think the recent appreciation of the euro is holding back inflation, but those are the small boxes below zero, because, for example, with the exchange rate, the earlier appreciation with the lag structure is deemed to be more powerful for now compared to the more recent appreciation. So again, that's just helping you to understand in the models that the euro system runs how this spillover from energy and the exchange rate to core operates. The reason why the exchange rate is there is it's, in the end, it's a level effect. You're not going to have the currency depreciating by 2% a year every year indefinitely. Okay, so again, it's probably with various turning points and so on, not a good idea only to look at 1 year, 1-year basis inflation rates. So looking at 3 months and 3 months is also helpful to think about, are there turning points in inflation? And if you go from left to right here, in headline, you do see this very large decline in momentum. So if you did it on a 3-month basis, you already have seen a big decline in inflation. So the fact inflation is still 8 point something is basically reflective of this 1 year behind, if you like, a calculation rate. Where's that coming from? You can see with energy, 3 month and 3 month, it's already a deflation force, given the very large turnaround in energy prices. But let me mention a couple of factors where it's still pretty strong. In food, yes, it's fallen a little bit compared to the 12-month measure, but it's still sky high. There's a lot of momentum in food inflation. The most remarkable is maybe goods inflation. There's a lot of momentum in goods inflation, which is very unusual to having goods inflation so high, and I'll come back to that in a minute. And then with services inflation, I think there's a nuanced picture here, which is, if you do it on an unadjusted basis, you might say it looks like there's a big decline in services momentum, which did kind of reverse a little bit in February, but more or less there has been a big decline. However, this is where all of the administrative prices issues kick in, and especially, I just did one adjustment here, which is the €9 train ticket last summer in Germany. So the dotted line is what happens if you take that out. Because what happened is, with that subsidy, it made the price level lower than you might expect last summer. And then when it was lifted last September, it raised the services price level. And of course, when you're looking at 3 month and 3 month, that kind of administrative decision plays a role. But actually, we did this, and I think it captures something, the dotted line. That dotted line shows you there was a surge in services inflation this time last year when we reopened. So when we reopened, if you think about these pricing decisions, March, April, May last year, they were really strong. Because upon reopening is a fantastic time to raise prices for all of those services activities where people were so desperate to consume more and where supply was still limited. And then compared to that surge in prices last spring, there was essentially some stabilization later on. And of course, coming into this spring, this is going to be a big issue for the coming weeks. Okay, so I've emphasized there that food inflation and goods inflation is really, really high compared to what we might expect. So why did I show you pictures of pretty strong declines in food inflation and goods inflation? And essentially, this is where our pipeline analysis kicks in. So here on the left, I show you various indicators from earlier stages of production, intermediate stages, producer prices, import prices, and so on. On the right, the solid yellow line is basically a local projection technique, which combines all of that and says, if you take that information, what is the project for the dynamics of food inflation and goods inflation? And it did a good job last year. It was a leading indicator. But basically, this indicator is projecting big declines in food inflation and goods inflation in the rest of this year. So again, to the extent those cost pressures are feeding through the different stages of production, this is behind the fact in our forecast we do have big declines in food inflation and goods inflation. Okay, so the basic conundrum we face is that all of these measures of underlying inflation, the standard measures we maintain, are still high, between 4 and 8. And at the same time, we are projecting in the medium term inflation to be a lot lower. So how do you reconcile this issue? So I suppose right now, to many people, what it says is, hold on a sec. There's a mismatch between your measures of underlying inflation and the forecast. Now, part of that is, for some of the reasons I just said to you, that there are basically reasons to believe, by looking at the indirect effect of energy on core, by looking at the pipeline, that essentially there are data points here which suggest that these underlying inflation measures will ease over time. The more empirical person, or pure empiricist, in the narrow sense of saying, show me the data, might say, until you see these numbers come down, you're going to be concerned. So what this really calls for is really a very detailed data analysis. And on the right side, I make different cuts of the data here. So let me emphasize, for example, with core inflation, there's a very different pattern between the red line, which is the energy-intensive part of core, and the green line, which is the light green, the non-energy intensive. So what it tells you up to now is basically the driver of core inflation has been the energy-intensive sectors. And again, with energy prices reversing, that component should ease. However, as the President also emphasised, the orange line here is the wage-intensive part of core, which has not been important up to now, but is projected to be more important this year especially. So this is why we do have this balancing act, this contest between some forces which are increasing in strength and some forces that are decreasing in strength, which explains why we do have core remaining quite elevated now, but also the projection is it should ease over time. Now, one issue in that easing is, do we think the recent situation is going to sustain itself in terms of the behaviour of profits? So really, if you think about the overall price of anything, there are 3 components. One is the input cost, the non-labour inputs, so intermediates, energy, whatever inputs you need to use. And then on top of that, you have value added, which is the mix of the payment to labour and the mix of the payment to the owners in terms of profits. And what I do on the left side is I chop up the pandemic period into 2 parts. One is from the end of 19 to Q1 last year, when the pandemic was basically intense. And then what happened since? What happened in the last 9 months of 22? And it's important to have that differentiation because it shows you how different sectors have behaved. So during the pandemic, there was a lot of, and if you think about a lot of sectors basically being world price takers. So if the world price went up because of bottlenecks, high demand, and if you're not paying your workers anymore, it's a huge increase in profits. And you see that in mining, utilities. Now, again, the scale, I have a uniform scale here. You might say it doesn't look so spectacular in manufacturing, but it's quite strong in manufacturing and so on. Whereas in the last 9 months, there's been a handover to those sectors benefiting from the reopening. So if you look down at the bottom of the slide, you see things arts, entertainment, you see in the middle trade, transport, accommodation, food, which were killed in the pandemic, but have benefited a lot in the reopening. So this role of profits in particular, in different sectors have a different timeline, but basically it's a general point, is there's been a lot of profit taking, and again, this helps to explain why, even if labour costs go up in this year, to the extent some of that profit-taking environment eases, then overall inflation can ease as well. Now, as the President also emphasised earlier on, I mean, the core to a lot of this is going to be wage behaviour. So let me emphasise what we have. What we have is essentially this year being the peak, and then the next couple of years for nominal wages easing quite a bit. And behind all of this is essentially the catch-up narrative that at the start of this year, there's a big gap in real wages because the surprise inflation last year did mean real wages fell quite a bit. So for any given slack or strength in the labour market, that catch-up effect means we would expect to see nominal wages grow more than normal this year. And that's going to be ongoing. Europe is a staggered labour market. It's not over in one go. And that's why it's still quite elevated, but with smaller increments for the next couple of years. And so in the middle panel, I show you, we have this current level of real wages well below where you might expect, but there's going to be significant progress in the next couple of years in that. So again, the fact we have inflation falling is based on the presumption the peak of that is this year. And I'm sure we'll come to that later on maybe. And that's also where we're paying very close attention to see is that going to pan out. So I think the turning point issue is going to be quite important. Right now, towards the end of last year, we were seeing significant wage increases. Now, not out of line with what we expect. The wage behaviour has not been surprising to us. And I think that's important. What's also true, though, is later this year, when we start to see the negotiations for 24, it will be important to see those coming down, to see that negative slope in action. Let me also mention just one thing in terms of the labour market. It's, of course, fantastic news that unemployment is remaining low. It's important that a very strong foundation for demand is people feeling secure in their jobs. And the fact that employment has grown, the fact that the labour market has low unemployment is important. In terms of the overall amount of slack in the labour market, it's also important to take into account the remarkable recovery in the labour force. And this is atypical compared to the US and the UK. I mean, the President gave the numbers in her speech, but you see here on the right just how strong the labour force has grown with a very big increase in net immigration. So the ability of the economy to grow, the ability of disinflation to happen is reconciled also by pretty strong increase in the labour force. Okay, I'm nearly done. I know I'm probably taking up time here. Okay, so in terms of another cross-check is with market views and also household views of the inflation dynamic. The left side basically broadly says the market view, and also, by the way, in the surveys of people in this room, is that people agree inflation is going to come down quite a bit this year. At the bottom of the left panel does show the revisions. So there's also an agreement. It's going to be a bit slower this year for core inflation probably than might have been expected. And on the right side, there is, I think, a fascinating, consumer survey evidence that essentially they also believe the slope of inflation is negative. It's going to fall this year. They're more confident it's going to fall compared to last year. And they're also more confident over time inflation will get back closer to 2%. So you do see turnarounds in those data as well. Let me not dwell too much on the yield curve. You all follow that quite closely, I'm sure. Let me talk a little bit on the right side, because a lot of people find it interesting or somehow a summary indicator to think about where are real rates. So we have two calculations of real rates here. The kind of purple zone here is basically, if you think about one quarter real rates. So it's today's deposit rate minus the 1 quarter ahead inflation rate. And yes, that's still negative right now, but it's projected to get positive pretty quickly. The orange zone or yellow zone, a bit colorblind, is the 1 year ahead. So the average deposit rate over the next year compared to the expected inflation rate over the next year. And that is in firmly positive territory already. So again, in thinking about the how interest rates affect the economy, take your pick. Let me emphasize in terms of pass-through, on the deposit side, it's basically happening in line with what we expect. And because deposit rates are going up quite quickly, the deposit rates available to firms and to households are going up quite quickly as well. I'll look at country detail in a second. On the right side, it says overall bank funding costs, if you think category by category, are also rising. So whether bond rates or the deposit rates they have to pay to firms and households. Let me emphasize, though, it's not just about the individual lines, it's the composition. Over time, you might expect to see more households move away from overnight accounts to term deposits, and that's going to raise the cost of funding or to move to money market funds for that matter, and that will raise the cost of funding to banks. For firms, you know, again, we think it's on track with what we might expect, but because we're doing quite a lot of hiking, that's quite a lot of rapid increases in the cost of funding to firms. And we also clearly see in the BLS the tightening of credit standards. And in terms of behaviour, the mix of credit demand, credit supply does see this pretty sharp slowdown in credit volumes at the end of last year. And then for households, we have a pretty uniform, pretty strong increase in the cost of mortgages across the area. Uniform in the sense of the rate of change levels, there's still some differences. And we are seeing a turnaround in credit volumes to households. And let me just finish with this last one. In terms of other dimensions of behaviour, the left side is interesting in the sense of depending on the country, the relative merits of taking a fixed rate mortgage versus a variable rate mortgage is moving. So you see in some countries quite a big change in behaviour with kind of the fixed rates being unattractive and more households moving back to variable rates. So the President mentioned this big decline in variable rate mortgages. That's turning around in some countries. So when we think about over time, more and more households being exposed to floating rate debt, now that's going to move slowly, it's a stock, but it's there. The right side does have this issue that essentially the time deposit rates in most countries are tracking the policy rate, but with some notable exceptions there, if you think about the level of competition in those markets and the ability of banks to decline to raise time deposit rates to all households. So let me stop there in terms of this kind of partial run through to some of what we look at. Thank you.
Thank you very much. Thank you, Philip. We go straight to Monika's presentation.
Good morning. I would like to, first of all, thank the organizer, Volker Wieland, for inviting me to this conference. I think he's doing a superb job by bringing together academics, policymakers, and also the media. I think we really need to talk to each other, and we probably need to do so much more. Okay, so I'd like to share with you my views on the topic, and the way that I've structured my presentation is pretty simple. I was asked to come up with a question, with an answer to the question that is at stake. So what does it take to, what is required to bring back inflation to its target? So I'll come up with an answer. Then I'm going to zoom in onto labor market issues. I'll elaborate in particular the important role of inflationary expectations for the wage formation process, which is where central bank policy comes in, quite importantly. And then I think it's also, I would also like to use the opportunity and highlight a couple of structural issues, challenges that we are facing in the euro area that the ECB actually can do nothing about. You simply have to live with that, and like all of us will have to do. It's national governments that need to tackle those. Okay, let me start at the beginning. So, what does it take to bring inflation down? How to get inflation back to target? My answer to that question is straightforward and relatively simple. I think that the ECB needs to continue to credibly communicate that it is committed to maintaining price stability, and that it is also committed to quickly return to bring the inflation back to its target, and it needs to underline that by taking respective actions, in particular by further raising key policy rates and also by continuing the process of quantitative tightening that you started some time ago. Okay, in brief, whatever it takes to bring back inflation to its target, that's what you need to do. I think you're well on your way to actually achieve this. Why is that so terribly important? Well, it's important because, as we all experience in our everyday life right now, high inflation rates effectively impose an inflation tax on all of us. It's making life really, really expensive. Moreover, high inflation rates mean redistribution of resources from lenders to borrowers. That's one aspect. It's just a fact. I'm not going to comment on it. And lastly, high inflation rate also adds to the uncertainty about the future path of the economy. So it's true that policymakers are facing a lot of uncertainty out there, but it's also true that high inflation adds to that uncertainty for agents in the economy. So the ECB must demonstrate that it has taken back control of monetary policy in order to ensure credibility. Just earlier today, I was talking to a journalist, and he was asking me, so, Ms. Merz, do you think that the ECB is facing a credibility risk? And I said, no, actually, I don't think so, because I really think that right now they are having things under control, things are on track. But if you had asked me that question about a year ago, not clear to me what I would have answered. So, re-establishing or maintaining credibility is super important. And lastly, it's equally important to break inflationary expectations, because those inflationary expectations are important. They feed in essentially into all nominal prices, be it interest rates, be it wages, goods prices, and unless you succeed in bringing down those inflationary expectations, fighting inflation might be an uphill battle. So let me zoom in on the role of inflationary expectations when it comes to labor markets. It has been mentioned already on the last two talks that we heard that for many, many decades throughout the euro area that workers were actually facing declining real wages. But that has changed more recently. In the recent past, we are seeing across the euro area a rise in real wages. And that is because of two reasons. And it's very important that we keep those two reasons separate. One of the reasons is of structural nature. It has to do with the increased labor shortage that prevails throughout the euro area. But the second big important contribution is inflationary expectations. And this is where monetary policy comes in, right? So rising real wages has to do with an increased labor shortage that we are seeing across the euro area. But the second big component that must not be underestimated is inflationary expectations. The ECB can't do anything about those structural challenges. The fact that the euro area is facing an increased labor shortage, but it can very well do something about the inflationary expectations, which do feed into real wages. And this is something that policymakers must remember. So those labor shortages have been quite, right now they are observed across many Western industrialized countries. They are observed across many sectors, across many, many occupations. So this is an omnipresent phenomenon. However, labor shortages they're more severe, first of all, at the lower end of the wage distribution, and they're also a lot more severe in fastly aging societies. And I'm afraid to say that in the euro area, we actually live in fast aging societies. So why is this labor shortage particularly severe at the lower end of the wage distribution? In our everyday language, what do I mean by this? I mean that there's a lot of wage pressure for truck drivers or for in the transportation area, in the hotel and restaurant industry. So this is not, these are no high-skilled sectors, but workers in these sectors have been demanding significant wage rises. And this is something that David Auter just recently pointed out for the United States, but this equally holds for the euro area. The second thing, that's an aspect that distinguishes, for example, the euro area from the United States. It's this aspect of a fast-aging society. And as societies are aging fast, so are labor forces. And this aging of the labor force has strong implications. It typically comes along with a decline in labor productivity. And yeah, so this upward pressure on real wages that we have recently observed, it arises from, like I said, it arises from higher labor shortages in the euro area, but in the United States. But keep in mind that this holds at the same time where we do observe the exact opposite sign when we look at growth in labor productivity. And this is something that hasn't actually been mentioned, but I think it's crucial in the entire process. Average labor productivity, or the growth of average labor productivity in the euro area has been low. It has been much, much lower than in the United States or in other industrialized countries. And this is something to keep in mind when we are trying to assess, okay, so those wage demands, those real wage rises or declines, to which extent are they creating the risk of a wage price spiral? Some also call it a price wage spiral. Well, I think this is something that's not to be underestimated. Let me say that again. Average labor productivity in the euro area over the last 20 years stands at 0.9%, whereas in the United States, it stands over the same time period at 1.6%, so it's much, much higher. Well, it's significantly higher, I dare say. Yes, and average labor productivity has been on the decline in both areas. So why does this matter? Well, let me just look at a simple example. It's already been mentioned here in the presentations. Just very recently in Germany, it was postal workers who succeeded in securing themselves a nominal wage rise of 11.5%. So if I contrast this to the average inflation rate in Germany of 8.7% of the last year, that leaves me with a real wage increase of almost 3%. So far, so good, nothing extraordinary. However, if I contrast it to average labor productivity, which stands at 0.9%, there is clear pressure for price increases. Okay, labor productivity doesn't really justify this wage rise, and this is something that we need to keep in mind. So what does that mean for central bank policy? Like I said, there's nothing that the ECB can do about those structural challenges, the increased labor shortages. It's national governments who will have to tackle it, be it by bringing in more women into the workforce, be it by reconsidering in-migration, be it by reconsidering pension reforms like we just have seen in France. But you can do something about inflationary expectations, which directly feed into those real wage demands. So taming inflationary expectations strikes me as being even more important in the euro area than in the United States, given the relatively low labor productivity growth. Okay, so that brings me to a question, and I do think I have enough time to actually address this. So why is labor productivity growth in the euro area so small? Like in Italy it stands at 0.2%, very recently. In France and Germany right now it stands at 1% per year on average. This is relatively small. How come? Well, the usual suspects, as we think of it, the usual suspects are the aging labor force. It's too little business investment, and I'm going to talk about it next, and education policy. Let me just briefly zoom in on the role of business investment. So what you're seeing here on these two graphs, I'd like to ask you to focus on the right-hand side graph. The left-hand side graph simply reports the share of private total investment to GDP, both in the EU without Ireland, because if you included Ireland, the share would be significantly lower, and maybe Philip knows why that is, but that's what the data say. So, and the gray line relates to the United States. But I want you to focus on the right-hand side, because on the right-hand side graph depicts the development of business investment as a fraction of GDP, again, in the EU without Ireland, blue line, and in the United States, gray line, for the last 20 years. And so what do we mean by business investment? And what does it have to do with labor productivity? Business investment covers things like machines and equipment that matter for productive capacity. It also captures intellectual property assets such as patents or trademarks that matter for international competitiveness. And lastly, and very importantly, business investment captures investment into ICT, information and communication technologies. Okay, if I can also phrase it differently. So if you look at the development of these graphs, what we are seeing is a widening gap in this investment rate between the EU and the United States, and I take it that this is one of the key reasons for labor productivity being continued to be low and to be significantly lower than in the United States. It's definitely not the only reason, but it's a key reason. In simple words, what we are seeing here is a significant lagging behind in digitization. Okay, so a few more minutes, Volker? Okay, good. So I don't want to spend much time talking about what has gone wrong in the euro area, maybe also with the monetary policy over the last 20 years. I'll try to be short because I only have 4 more minutes. Volker's already at my back. So let's face it. The latest since 2015, the ECB pursued very expansionary monetary policy. Yeah, there were good reasons for that. There was a sequence of crises. You launched your various asset purchasing programs. You maintained interest rates very low, mainly in order to stimulate consumption, private or government, in order to stimulate investment, private or government investment. So I think it's legitimate to ask the question, so have you succeeded, and what actually have you supported by this very loose monetary policy? I dare say that not only, but also a lot of the extra money that was in the system went to government finances, financing government consumption expenditures, and not enough government investment expenditures, quite honestly. But I'd like, and why does that matter? Well, private or government investment matters for expanding production capabilities. And if you keep spending, I mean, that is governments, if governments keep spending their money on income support programs, on supporting consumption, that's nice and fine, that's important as well, but it comes at a cost of government investment, and we need it very dearly in the euro area. And look at the infrastructure, the state that it's in, we dearly need more public investment, for example, in infrastructure, and also more digitization. I dare say that the EU Recovery Fund, I'm really only briefly mentioning it, but this EU Recovery Fund that was launched in May of 2021, there were good reasons for it being launched. There was a dire need of it being launched because those who were responsible obviously must have recognized that there was not enough investment, not enough R&D that was taking place, so they launched it. Unfortunately, because of negotiations, because of bureaucracies, it came very late. It came about 14 to 15 months after PEP was launched. So that was a little unfortunate. What does it have to do with inflation and inflationary expectations? This is my penultimate graph, and then I'll stop. It's one of my favorite graphs, I have to say. It's super simple. Okay, what I'm depicting here is in red annual growth rates of the monetary aggregate M1. And I'm measuring it on the left vertical axis, and I'm depicting it against measured inflation rate, which is depicted in blue, and it's measured on the right vertical axis. So just a few things I wanted to take away from that graph. The first thing to see is that, yeah, there were these spikes in the growth of this particular money aggregate that had to do with the launch of the APP in 2015, that had to do with the launch of PEP in 2020. Now, following this launch of the APP in 2015, we are seeing a rise in the inflation rate. Okay, this blue line rises, but not by very much. Okay? Now, I do remember I attended conferences in 2019, 2020, and at that time, academics were extremely busy debating this missing inflation puzzle. Okay, well, you don't talk about a missing inflation puzzle unless you're expecting inflation to take off. Yeah? Then came the corona pandemic, and another series of PEPs was launched. So that brings just is indicated by the second red bump. Yeah, and then all of a sudden the inflation rate, the inflation took off. One thing I want you to take away from that from that slide is the following, and that's my view of things. There was already a lot of inflationary pressure in the system because of super expansionary monetary policy and relatively low real economic activity prior to the onset of this Russian-Ukrainian war. That is, in January 2022, that measured inflation rate stood at 6%, and only then energy prices hit. Okay, which is why I refuse to talk about an inflation shock. I will never use this word. I mean, it doesn't just accidentally happen, but inflation it's an endogenous variable. It's being produced. Okay. So let me say that again. In January 2022, inflation stood at 6%, and then the Russian war took off, and then energy prices hit, and that quickly took us to 10%. Okay, and the rest is history. I'm not going to comment on that a lot. But the trouble with that big rise in the inflation rate that shortly stood at 10% is that you're influencing people's expectations. Yeah, they don't know what to make of it. They're simply confused. They don't know what to make of it. So it's super important to bring not only inflation down, but to bring inflationary expectations down for the reasons that I've mentioned. So, lessons to be learned. I'm a big fan of, given all the complexity of the issues and the economies and everything's being intertwined with everything else, I'm a big fan of keeping things simple. And this is what your price stability mandate actually tells you to do. Yeah? Control inflation, keep it simple, and I'm also a big fan of evidence-based analysis and policy recommendations, but I don't believe in micromanagement. Things are way too simple, way too complex. You cannot engage and should not engage in micromanagement. Disciplining inflationary expectations is key to controlling inflation for the reasons that I've tried to elaborate. It's also crucial to continue the quantitative tightening to tame those inflationary expectations and avoid worsening the economic situations. And the last thing I want to mention is I think it's super important that the ECB clearly communicates what it does and where it's heading. And I don't see any point in the ECB, I mean, don't get me wrong, but telling workers, oh, could you please moderate your wage demands because you're getting us into trouble? Well, let's be honest. If we were those workers, we would do the same thing. We would also ask for very high wages. No, it's the ECB that's in charge of controlling inflation, controlling inflationary expectations, and that's the way to go. Thank you.
So thank you, Monika. We go straight to Michael. And then we have time for questions and answers right after the third presentation. I think we're going to have about 4 lead questions. We're going to take several rounds of questions and then some responses in final round. So, Mike.
Okay, well, it's great being back here. I taught a course maybe, I don't know, sometime way before the pandemic on financial crises in historical perspective hit this university. So it's nice to come back and, you know, you created a financial crisis that we can talk about again. Let's see. How's it work? Yeah. Okay. So my talk is called History Lessons for the Fed and the ECB on Monetary Tightening and Financial Stability. So don't worry about these slides; they're overwhelming. We'll get through them. Okay. So my presentation puts the recent inflation experience in historical context, and I provide some lessons from the past to avoid future policy mistakes. So I'm going to focus on the Fed first and then turn to the ECB. So the 3 big policy lessons from monetary history that the Fed should have heeded in its policy responses to the COVID-19 pandemic. First, that there are 3 big lessons. Yeah, so the first one is close analogies between the fiscal and monetary responses to the pandemic and the financing of world wars, especially World War II, that led to inflation. Secondly, since 1920, I mean, since the beginning of the Federal Reserve, they have frequently been behind the curve. Okay, it's frequent. You look at all the business cycles, and I did a paper last year with Mickey Levy for the Hoover Monetary Policy Conference. You look at every business cycle, and the majority of them, they tend to wait too long. They tend to be easy too long. That leads to inflation, and then you have tightening, and then you have a recession. So this is a very old story. And the third is that Fed tightening and disinflation is frequently followed by financial instability and credit crunches. So what we're seeing now, to me, was totally predictable. Okay. So let me just go through the history of war finance, and then shift to the behind the curve, and then and financial instability, and then I'll talk about the ECB. So the monetary and fiscal authorities in the U.S. and a lot of other places treated the pandemic as an existential threat, which it was, and it was like the world wars of the 20th century. And if I focus on the U.S., World War II led to a massive U.S. fiscal expansion, that the share of spending and income rose to 32%, fiscal deficits close to 28%, the debt ratio to 120%. And the war was financed by taxes, 40%, bonds, 34%, and seniorage, inflation, 24%. And what the Fed did, and what it did then, what it did recently, is they accommodated the Treasury. They kept interest rates low. They had a low interest rate peg. Okay, they followed what we call today yield control. And they completely gave up their independence to the Treasury. And so the Fed became an engine of inflation, and total M2 expanded during the war by 102%. Okay, inflation wasn't very high. It was 4.5% because you had extensive wage price controls, and they worked because people, in a sense, viewed this as this terrible threat. And real cash balances increased because you had rationing of consumer goods and credit restrictions, and there was pent-up demand during the war. And then what happened was, after the war, everybody thought, the economists, the Fed, everybody thought that there was going to be a deflation, as occurred after World War I, but that didn't happen. So they kept the pegs going, and then they took off the wage price controls, and you had a surge in aggregate demand, a rebound in velocity, and that plus supply constraints led to an inflation rate of 11.5% from 1945 to 48, and there was a widespread housing boom too. So then the Fed tightened in 1948. They couldn't raise interest rates, so they raised reserve requirements and capital requirements, and there was a recession in 1945, which ended the inflation. And then the Fed's independence was restored in 1951. The peg policy was ended. So this is the analogy. It's like the aggressive fiscal response to the pandemic in the US, the fiscal deficit increased over 25%, was like a wartime response. Other countries, it was less so. And monetary policy was accommodative, with zero interest rates, and the Fed eventually bought half of the new Treasury bonds. M2 soared by 40%. And also, real cash balances increased, velocity dropped, and then it bounced back. So it was a big surge in aggregate demand, and there were supply shortages. So you got the peak inflation of CPI was 9%. The cumulative increase was 15%. Now, the Fed attributed most of this inflation to transitory supply shocks. They did not pay enough attention to the surge in aggregate demand. They forgot what happened in World War II. Okay, the second history lesson is the Fed's often been behind the curve. I'm not going to spend a lot of time on this. I gave a big talk last year in the US on this and other places. But there's a long history of mistiming monetary policy around business cycles. And there's this evidence of delayed exits following recessions, leading to inflation and then often recessions. And in this paper with Levy, we say, well, why is this? We look at the evidence. It reflects evolving theory over time, okay, going all the way from looking at the post-war, from Keynesian economics to the present. Forecasts, they're often wrong, and then often political pressures. So rather than go into it, you come up with this behind-the-curve phenomenon that we just had. Okay? And the last thing is disinflation and financial instability. So this episode right now of the Fed raising interest rates to lower inflation has generated financial instability the last 2 weeks. SVB Bank in California, Signature Bank, New York, First Republic, and now in Europe, Credit Suisse. Well, if you look at the history, what happens, it's happened a lot of times, and what happens is when it happens, the Fed cuts its tightening short to protect the financial system. Happened in 1966, there was a credit crunch. 1982, Volker stopped because of the beginning of the Latin American debt crisis feeding into the New York banks. A credit crunch in 1991. The Asian financial crisis led to a flipping of policy. And even the 2007 crisis was a tightening, and they ended it. And it's always the same story. You have rising rates reveals underlying imbalances. Where it is changes, but it always is there. And another thing that we see in history is that when you have episodes of deflation, like before World War II, and disinflation since World War II, it's often associated with financial instability. I've done research with Dave Wieland at the Federal Reserve Bank of St. Louis, and we found that for the US, for 200 years, UK even longer, you see this correlation. Okay. So the Fed's got this challenge. You've got excessive monetary ease and delayed exit with deeply negative real Fed funds rate and a surge in money. That was a mistake. Okay, so they did it. They were 6 months late. And so how do you do that? How do you reduce high inflation and maintain financial stability? Well, a well-seasoned solution is you follow Tinbergen's principle. You use lender of last resort tools for financial stability and monetary policy for price stability. And the ECB did this. I was really pleased when that happened. They followed the principle. Will the Fed do this? Well, that's a question. Will the Fed maintain its anti-inflation resolve if its tightening leads to financial instability and recession? And we'll see. Okay, I'm not overly completely optimistic. Okay, so now we get, and so this is a picture that shows you everything. This is showing you the inflation rate and the effective policy rate, and you see that what you really need to end inflation is you need positive real interest rates. So they're almost there. Maybe they're there in some measures. And here is a Taylor rule. A Taylor rule, I won't have time to tell you how we did it, but a Taylor rule relative to the funds rate. And they're getting there. So they were behind. It's pretty close. Okay. Okay, so now I turn to the ECB. And you've had a shorter history and a different mandate than the Fed, and you face different obstacles, but it could have learned from the member nations' histories. Some countries have had pretty checkered records, just like the Fed, Greece, Italy, France, okay? But then other countries, you know, Germany, the Netherlands, and the Austrian Central, but they had a much better post-World War II record. That could have provided valuable guidance. So we have a figure here, and I show the inflation rate in Europe, and it's higher than Europe, higher than the U.S., and we've already heard this, but you're in a sense, you are behind the curve on inflation. And I've got another figure here, which is we did a Taylor rule rate. We did the same figure. We used Volker Wieland's data. And again, now you see the gap is much, much bigger. So you're really far behind. Okay. But there's a difference in the challenges that the two central banks face. I mean, you've had a larger exposure to negative supply shocks and slower aggregate demands as this fiscal stimulus was less. So that story's not quite the same, but you still have challenges which the Fed doesn't face. They're quite different. First, and this is an old story, but I'm going to bring it up again, is you don't have a complete fiscal union, and you have different fiscal regimes across the EU. You've learned and had to maintain overall fiscal stability, and you've had problems with Italy and Greece, et cetera, and they're coming back. And you don't have a complete banking union. You don't quite have uniform U.S. FDIC-style deposit insurance. And so I'm going to go into these, but these slides are dense. You're not going to have to read them, but I'm basically saying that the U.S. fiscal union, you know, it took a long time to evolve. Okay, it goes from Alexander Hamilton in 1790, creating a U.S. bond, okay, and setting up a good fiscal space, okay, and it evolved through the 19th century after a series of state debt defaults, so they came up with the no bailout clause. And then by the 20th century, you've got the complete fiscal federal system set up by Roosevelt in the 1930s with interstate transfers of income tax revenues and a federal social security. In Europe, it happened. The Maastricht Treaty laid the groundwork for a common currency and a common monetary policy, which was a lot like the Fed, but fiscal sovereignty was retained by the member states, and fiscal space was limited by the SGP. And so what that meant was that the main responsibility for macroeconomic stability rested with the ECB, whose primary mandate is to maintain price stability. And during the pandemic, the euro area's fiscal space and flexibility was temporarily increased with this NGEU, and it in some sense had a lot of aspects of the U.S. fiscal union, and you created a pot of money that was financed by bonds issued by the ECB to be serviced by future EU taxes. But it's very politically contentious, and it was temporary, and it's unclear whether it's going to stay. Okay, so whether you'll ever or will get a true fiscal union. And so that's one issue. The other issue is financial stability. The absence of fiscal and a banking union, that creates challenges to the ECB as it normalizes monetary policy to reduce inflation. The first is that, again, you all know this better than me, but different EMU members have different fiscal institutions and political economies. So as you raise your policy rate, as ECB raises policy, that could exacerbate debt service costs in those nations that have high debt ratios and wide bond yield spreads. And that could lead to a downgrading of the sovereign ratings and create the potential for another debt crisis as occurred in 2010. So, will the ECB have to do it again? And moreover, without a complete banking union, that if tight money does what's happening in the States now, and the disinflation happens, that could lead to financial instability and a banking crisis, which means, again, it means a lot of work. So I have this slide here, which kind of shows a little bit of how this could happen. So this shows on the left, you've got these rising spreads of government bonds, sovereign debt, and on the right, I've got this table which shows you, it compares 4 countries, Germany, Italy, Portugal, and Greece, and you see that there are some potential risks going with some of the less advanced countries. And the last thing I'm going to talk about is the regional effects of tightening in Europe. The ECB focuses on harmonized inflation, but you see a really wide dispersion of inflation rates across Europe. It's quite striking. It ranges from 4% in Belgium to 22% in Lithuania. And you see this, I have a figure here that has all of the different inflation rates. And the blue lines are the different countries, and the brown one is the average. And that reflects different degrees of economic development and exposure to energy. And so when the ECB tightens, that that could have diverse effects on real output, which really depends on the extent of nominal rigidities in these different nations. So in the States, when this happens, you got with both a fiscal and a monetary union, with automatic fiscal transfers, that some of these divergences can be worked out. And again, the divergences in economic performance across the EU nations depends on fiscal arrangements, the fiscal space, even if all of the restrictions are removed. So I'm just raising, in a sense, I'm saying that the ECB is behind the curve on inflation, and it's going to be a tough. I see this if things as they're happening in the U.S. If it happens here the way it's playing out there, that it could be a lot of work for the ECB to achieve its goal, which is the admirable goal, and you want to have price stability. And the fact that the ECB has this mandate, okay, I think that's terrific. But it's going to be a challenge. Thank you.
Thank you very much, Michael. I made a mess here, okay. Philip, do you want to have a quick chance to respond to the 2 panelists, or should we go to the lead questions? Decision is up to you.
I would guess in answering the questions I get, I'll be able also to cross-reference maybe some of the other contributions.
Okay. Okay, so let me call up the first 4 questions. Sorry, I made this. Okay, so let me call up the first 4 questions. Let's let's ask them all together, one after the other, and then have a round of responses. So I'll start with, and after that round, we have open floor for questions. So I start with Jari Stehn from Goldman.
Thank you. So given the recent financial market volatility, I wanted to ask about the separation of monetary policy and financial stability tools, where as was said earlier, you use the policy rate to cool inflation, you use liquidity tools to contain financial stress. I think the historical record, as we said, as we heard earlier on this, is somewhat mixed. I think in the UK, the LDI phase last year seemed pretty successful. The separation was harder in 2011 in the euro area, and as we heard, the Fed often stopped in response to financial stability concerns. And so my question is, how do you see the separation given the current inflation and banking system risks? And under which conditions would that separation break down such that market stress could have implications for the monetary policy stance? Thank you.
Thank you. The next question is Dirk Schumacher, sitting over here. Yes.
Thank you.
From Natixis.
Corporate profits and wages have been mentioned many times during the presentations, and I would and President Lagarde has asked for a fair burden sharing when it comes to the terms of trade shock and all that. What would be a fair burden sharing here? What would define wage growth that's acceptable? What defines a profit margin that's acceptable? Will profit margins have to come down in order to make core inflation go down? And ECB tighter monetary policy, would it affect first corporate margins or first wider labor market, the ability of workers to ask for higher wages? Thank you.
So the third question is Sylvain Broyer. He's sitting right next to Dirk from S&P.
Thanks. I had a similar question, but also, I guess one question for Monika, Merz, and Philippe Lanes on the labor market slack, because listening to Monika, it looks like labor shortage are bigger in the euro area than in the US. We are hedging, so we are at risk of a wage price spiral. So you have a few where probably we are far in the positive narrow gap, if it exists. While listening to Philippe and looking at the projection of the ECB, it looks like the unemployment rate goes further down. Unit labor cost, wage growth has not been revised significantly up compared to the previous projections. So it looks like Philippe is more on a negative narrow gap. So if you can develop your view on the labor market slack and maybe whether there are structural aspects of the improvement of the labor market. Thank you.
And the fourth question is Ulrich Kater, who's sitting over here, so just next to Jari Stehn. So maybe you can. So from DekaBank.
Well, also for me, the most important question is the actual situation, the transmission process. That means the stress in the banking sector. We have no banking crisis, but we have stress in the adoption of the banking system to the new restrictive environment. And for me also I mean, Michael Bordo already raised the issue, but I would also be interested in the opinion of the whole panel, to which extent this banking stress we are seeing right now is able to influence the actual monetary policy decisions of the coming quarters.
Thank you very much. So we have at least two, if not three questions relating to the separation principle and what can be done, but also to labor markets. So maybe all of you have been asked. Let's start with Philip and then Monika and Mike.
Okay, so let me start with the fact that Europe went through a very severe crisis. Europe went through a very severe crisis 08 to 12. Many lessons were drawn from that crisis, including in terms of both from a policy point of view, but also from the point of view of those who run banks behave, those who are investors behave. Michael Bordo correctly raised the fact that we don't have a fiscal union, we don't have a full banking union, but everyone in Europe fully understands these points. And what are the mitigants of that? Much tougher regulatory standards, much tougher supervisory standards, tons and tons of attention paid to interest rate risk in the banking book, for example. So, you know, the starting point is it's not like for like, because one way you mitigate all of that is by paying a lot of attention. And again, it's not just the policymaker, the regulator, the supervisor, I'm pretty sure those involved in running banks, investing in banks, also have a high rate of risk aversion. The same also applies, by the way, to the private sector. I mean, one of the lessons of that time, and one of the reasons why, which I do connect to what Monika brought up about low productivity growth, is Europe, one of the lessons or costs of all of that was the last 15 years basically a high degree of risk aversion, a high degree of gloominess, a high assessment that Europe is not going to be a growth engine of the world economy, and with essentially saying, okay, I remain to be convinced that it's a good place to invest. So we did not have the spectacular growth period in these years. But if you like, the consistent and comprehensive approach to that is if you have a lot of buffers in the system. I mean, let me also mention excess saving. I mean, Europe has a lot of excess saving as well, partly through fiscal, but a lot just basically being unable to consume in the pandemic. And it's been years now, and what we've seen is it is absolutely affecting behaviour, I'm sure. But it's not the case there's been a big consumption boom in Europe. What we see is the savings rate approaching normal from above. It is not going below normal. So essentially, I think it's very welcome that households have now a big buffer. So in terms of some of the mechanics of how financial stress might play out will be watered down, if you like, by that savings buffer that exists. But I do think that's important. So the separation principle, let me also mention, of course, there's a big difference between bank-based systems and market-based systems. That the power of bank liquidity operations is obviously going to be much more general in a bank-based financial system than a market-based financial system. It gets through more of the cracks, if you like. So let me say, from my point of view, where we are now, is there are multiple possibilities here. One is it's a non-event. It turns out to be a spillover from Switzerland and America. And that spillover raises some questions which are then answered. They're answered by the regulators, they're answered by the banks. And it'll turn out in a few weeks, it's more or less been a non-event from a macro point of view. A second category is there will be changes in behaviour, and we will be looking not just for the financial system response, but for the private sector response. I mean, of course, it's everywhere, every radio programme, every TV programme is this a rerun? How should we think about that? And you might expect some pullback in consumer confidence and investor confidence. But again, if they see that there's stabilization pretty quickly, that may not matter too much. But to me, there's a middle category there of, yes, it's going to show up in our forecast, it's going to show up in our assessment, but just as one factor among many. And then, of course, we will always pay attention and monitor. We always, by the way, in all of our analysis, we always run scenarios about financial amplification. What happens if you get, accelerator effects where things amplify each other? But that's very much a tail scenario at this point in time. So for those reasons, I think we are, pretty solid and in our assessment that last week's decision was robust, but also solid in our assessment given the uncertainty that I would agree with the phrasing that presently is, if the baseline holds up, absolutely there's more to do. But we will have lots of time between now and the May decision to look at that. Let me comment a little bit on ageing and then the profit margin issue. Ageing is a super important topic everywhere, of course, but the way we think about it in general equilibrium does have the direct labour market effect, which partly, though, is mitigated by, number one, the re-entry or the return of migration. There's good participation rates, more than we expected from older workers in the euro area. So also having good policies to allow people work for longer or encourage people to work for longer. And by the way, when we count up the different ways the labour market is changing, let's also remember digitalisation and the ability of working from home to allow more people to work in the way they want to, or to find kind of middle grounds in working for longer. I think that's to be... and then let's not forget the other part of ageing, which of course is very good news, is greater life expectancy. but hand in hand with greater life expectancy and greater longevity risk is the huge incentive to save more. I mean, looking around the room, I'm sure all of you are perpetually recalculating that I'm going to live longer, I actually need to save more. And that saving more is anti for consumption, it's anti for demand, it's anti-inflationary, it's lowers R star. So, you know, the aging topic is important, but we need to look at it on all dimensions. Profit margins, what I tried to show in the graph here is, to me, there are two factors. One, there's many industries in Europe which are basically global price takers, or at the very least, are conditioned by global environment. So the ability of European firms to raise prices will be conditioned by what's going on around the world. It's also conditioned basically by the previous price increases. I note one German car industry firm last week basically has gone to zero inflation. They said, we're done with price increases. Because the price increases have been so big in recent years, they now assess the balance of that. And again, it's not exhortation, it's not lecturing, it's a commercial decision. And then in other industries, which are it's so connected. If you do an event study, it is so connected to the reopening at this time last year. You know, week by week, month by month, location by location. And also, we talk to a lot of corporates. It is so direct. It is so connected to the reopening. The question is, can they keep on pushing up prices this year? Or will they be basically saying, okay, I've re-established a good profit margin, I'll still try and increase my prices, but not by the double-digit rates I saw last year. So let's see. But I slightly disagree with Monika. It is no harm to sometimes give a broader perspective. Because, of course, in any given negotiation, there will be an intense focus on not just the macro factor, but the kind of whatever good or bad relations there are between the employer and the employees. And reminding everyone, look, we have a collective problem here. We have a collective terms of trade shock. That has to be distributed, partly maybe through the tax system, but partly in these negotiations. I think it's fair for policymakers to point that out. In some countries, they have more of a corporatist approach where they bring all the partners together. Whether that happens or not, I think there's no harm in pointing that out. Let me maybe stop there.
Okay, let me just address the two questions that were raised on wages and profit margins and the labor market. So I didn't mean to say that, you know, as economists, we should only focus on labor markets. Obviously, things are interdependent. What's happening in the global economy, in terms of trade shocks, cannot be ignored. Cannot be ignored by firms, cannot be ignored by workers. So there was one question that asked about acceptable profit or wage margins. So what are acceptable or wage or profit margins? From an economic perspective, that answer is relatively straightforward. Whatever ensures employment for an extended period, that's an acceptable wage margin. And workers and firms ought to be considerate about it. So, but I don't think that policymakers, that it's the job of policymakers to decide on what's acceptable. Workers and firms need to figure that out themselves. Firms want to stay in business, workers want to keep their job, so it's acceptable what allows firms to continue to do their business and workers to do their job. There was another question on wage rises versus drops that I didn't fully understand, so actually I'd like to leave it at that. Unless the person is going to repeat the question. Please feel free to, and then I'll try to answer.
Okay, I'm going to focus on the two questions about the separability principle. I think that the answer depends on whether you have a full-fledged financial crisis or not. If it's financial stress, but not systemic, then you do exactly what the ECB did. You use, lender of last resort and financial stability policies for that, and you use monetary policy to maintain price stability. But if it becomes systemic, okay, then you've got the dilemma. Then the dilemma arises, because if you pause on disinflation, you risk losing credibility in the face of high inflation. But if you don't, you've got another huge problem, which is got a financial crisis. And if it's a true financial crisis, then you just throw the book at it. That's it. That's the policy. And the financial crisis itself will reduce aggregate demand. I mean, I've done tons of research with Barry Eichengreen, and a financial crisis always makes recessions worse. They cause recessions. And that'll do the work, and you'll get the disinflation that'll come out of that. If you're in a situation like today, which I see it as in the US and probably spreading over here, I see a credit crunch coming out of it. That it's not that, I don't see it as a true, huge global financial crisis like 2008, but I see this regional banking crisis in the US as a really big problem, and it's going to lead to a tightening of credit, and the tightening of credit will likely reduce aggregate demand, and that might actually make the Fed's job and the other central banks' jobs easier, in the sense that they won't have to tighten as much. So I think that this is, and so the data-dependent approach is the way to go, because you can't just keep tightening and forget about it, because if you have a financial crisis, that just dominates everything.
Okay, so we can have a second round of questions. If you raise your hand, yes, Petra Geratz here, Krishna Guha, let's start with you. And I have 2 down here and 1 up there, so that's 5 questions. So let's see if we can collect those. I was looking this way, I know, but we'll have another one there, okay?
Okay, thanks very much for the really very insightful presentations. So Philip had a very detailed analysis of inflation, but he didn't really put much focus on the second part of his title of his presentation, which is monetary policy. Now, according to Mike's presentation, the ECB is far behind the curve and still has a lot more tightening to do. According to Monika, the ECB, it's very important for the ECB to have clear communications, especially in this time of uncertainty. So how come that the ECB then ditched its clear forward guidance and replaced it by some fuzzy boilerplate? Instead of providing clarity in this time of heightened uncertainty, because the ECB could easily have said, okay, we adopt state contingent forward guidance that's conditional on financial stability issues being contained. We think it is important to continue tightening policy to achieve our objective of price stability. Thanks.
So Krishna Guha, you just hand it over there, and then you can hand it down to Willem Bouter.
Thank you very much. Also directed mostly to Philip. A 2-part question, if I may. So first of all, the 3 pillars of the reaction function as articulated by President Lagarde earlier today combine some backward-looking and some forward-looking indicators. So the forecast is forward-looking, monetary transmission is forward-looking, but underlying inflation developments by construction are backward-looking. So is a moderation in the underlying inflation developments a necessary condition for instance, pausing rate increases? Or can you reach policy conclusions looking at the 3 in the round without all 3 tests having to be met? And then separately, with respect to the pace of any further tightening that might be necessary, is there a margin here by which moving more slowly can moderate stress without prejudice to what level of rates might ultimately be required? Thank you.
And we have Willem Bouter. You just hand it down to Rose. Thank you.
Thank you. Yeah, following up on the earlier point, we're almost 2 years now into this inflation surge, right? 2 years old. Yet, in the euro area now, let's just focus on that, HICP core inflation, I'm using a conservative estimate here, is 5.6%, and the policy rate 2 years into this cycle is at 3.5%. How come we have deeply negative real rates if policy is meant to be restrictive? I know that we are facing a potential financial crisis here, so, but as the point was made earlier, we can make contingent statements, contingent on financial stability being preserved, further rate hikes will be required, and significant further rate hikes. Thank you.
Okay, then we had a question down there. Is it okay if I collect these remaining 2 or 3? So on this side, yes. If you state your name and...
Yes, Giovanni Zanni from NatWest. Just a very small additional question on the inflation forecast, because we had the presentation on the March forecast. Of course, we have this further information coming from the financial restriction, whatever the size of it. But there's also another element that is, I think, quite striking, is about the energy price increase in 2024, which, as Philippe Lane said, is driven by an interpretation of the fiscal developments. Well, now we also have energy prices that are a lot lower. So I'm still a little bit puzzled by this number, and so if we can have a little bit of background about this number and if it could be also revised down. Thank you.
Okay, the lady there with on the left with the glasses, yes, raised the hand. Well, you have to make it up among the two of you.
Yeah, no, thank you very much, Fritzi Köhler, KfW. Very inspiring presentations and discussion. I just would like to mention the relevant complementarity between monetary and fiscal policies also, because I think in the historic perspective, I think it was very clear, no, the monetary expansions thereafter, inflation and disinflation with its cost. One point that you mentioned, which I think is highly relevant, is that there is a larger extent of energy price inflation in Europe as opposed to fiscal stimulus. And I think as much as I agree that we focus here on monetary policy, I think there is no way out, then also to look at fiscal policy, because after all, it's a supply side shock. So the measures also need to be taken into account. Of course, that also becomes more difficult with a rise in interest rates, but I'd be very interested in your view on complementarity between both policy areas, also in the historical perspective of disinflation. Thank you.
Okay, maybe we need to stop here. We take this set of questions more than enough. Shall we start with Philip again, Monika and Mike?
Okay, I mean, we communicate through different channels. We have the monetary policy statement, but right after that, the President has a press conference, and then you will have heard quite a number of Governing Council members come out also. And it's been very consistent, which is basically, if the baseline holds up, so the fiscal stress or financial stress turns out to be temporary and not sufficiently material to move the dial, then more rate hikes will be appropriate. So we're crystal clear. I mean, this has not been, there's no confusion about that. And it's way too early, at this point in mid-March, relative to a May decision, to basically take a stand about whether the financial stress is going to persist, get stronger, weaken, and so on. So I really think there's no confusion here whatsoever. Let me jump to Willem and then come back to Krishna. What I showed you is our real interest rate calculation. I mean, it's fascinating. I mean, we also, by the way, run tons of Taylor rules, absolutely, and we run tons of other types of interest rate rules. But a lot of that has been developed in the sense of kind of a minor perturbation to 2%. And it doesn't really matter where you take the 1 month ahead, the 1 quarter ahead, the kind of scaling of over what horizon you measure real interest rates doesn't matter when you're just doing a kind of minor type shock. It matters quite a bit when you're in a situation now where you do have inflation that's projected to persist, but not to remain exactly where it is either. There is base effects, there are other reasons to believe the inflation rate to fall. And what I showed you is that if you think, if you're going to pick one interest rate to summarize maybe the most relevant interest rate for the economy, I don't think it's too bad to use 1 year ahead and use 1 year ahead expected inflation. And now, when conditional on believing our forecast that 1 year ahead inflation is a lot lower than current core or current headline, we have solidly positive interest rates throughout the horizon. I invite, if someone says to me that the 1 quarter ahead interest rate makes some huge contribution to macrodynamics, I'd love to see it, because we had such massively negative short-term real rates last year. Is it the case there's massive arbitrage in that, saying, this is so crazy, I'm going to have a huge consumption boom or investment boom in response to that? No, we have not seen any big kind of response to the potential for very low real rates playing a pro-cyclical role. And this is where Monika, I think, heavily emphasizes, and this is why we did move quite a bit. Absolutely, if you have a mismatch between the inflation profile and the interest rate profile, that would be very destabilizing. If people believed we were going to persist with super low rates, with the inflation rate we have, that would have been a huge disaster. So the fact that we did move quite a bit, I think was sufficiently timely, that we have not seen a major destabilization of expectations. And in fact, in recent weeks and months, we've seen a much more of a stabilization or convergence. Look at the consumer survey, for example. So, I do think, and by the way, let me just, this is more of an academic debate, and we know that continue with what Michael showed, is there are 2 risk factors, being too late and also tightening preemptively when in fact that turns out to be a mistake. And I haven't looked at your paper with Mickey Levy, which I will do, but it's important also to have a full, both sides of that, because the post hoc saying, well, we've seen inflation, therefore I conclude you were too slow in hiking, I'd like to counterbalance that with all those episodes in history where maybe some central banks hiked too quickly and what happened then. Maybe it's covered in the paper and I'll look at that. Let me do the fiscal before I come to Krishna. So fiscal, we have an amazing fiscal group at the ECB who have done a huge measure-by-measure study of not just the price-based measures and also whether they are conditional on the existing, the fact, are they automatically relaxed when the price falls down, and the income-based measures. So our calculations where there is that hump in 24 are based on a super granular, super detailed assessment of what we have in front of us, country by country. Now, if governments change their mind, and in April we have the stability program updates, if countries change their mind, that number can move, but let's see. Let me also emphasize fiscal analysis. When you have a lot of price-based measures and you have a lot of transfers, the multiplier on transfers is so much lower in all models compared to government spending. So all of you trying to kind of simulate fiscal policy, this rotation from consumption and investment to transfers matters quite a bit. Okay, Krishna, so I think we have 3 criteria. We're not going to tie our hands, if you like, by saying here's a set of triggers or kind of veto points. So we are, and by the way, it's quite handy. Volker said we had some initial, when President Lagarde came, there was an initial quiet period. We used that quiet period very productively to run a strategy review. And in that strategy review, we took on many topics. One of which is we're going to base our decisions on a comprehensive joint assessment of all factors, not narrow down to any one element. By the way, one of the conclusions of that was exactly to have a mix of forward-looking and backward-looking, exactly to have this, not put all our bets on the forecast, to have the cross-check with underlying inflation. Where I disagree with your characterization where you say underlying inflation is backward looking. No, it's not. It's using yes, it's using the realized data, but with the filters necessary to get to the component that predicts the medium term. What I've said is the current measures look like they have good predictive power for the next 6 months. We're not so sure with the corrections for energy and so on, you know, how much you need to correct for that for the medium term. So it will definitely be, you can, you know, the collective judgment of the Governing Council will take all of those together. Let me stop there. Oh, sorry. Yeah. So let me make 2 more points then. One is, I mean, it's clear, and back in when we started hiking, I gave the speech in Barcelona about the logic of the gap to the terminal rate and then the speed of reaching there. And clearly, when compared to where we were, we're closer to whatever version of the terminal rate we want to pick. And compared to the pros and cons of the different types of uncertainty we face, clearly we've moved down from 75 to 50 because those relative considerations have moved. And we will, you know, have to see in our upcoming meetings what to do next, even under the baseline. It was, honestly, for me, it was open under the baseline about the right speed. Let me make one more point, because, I mean, some people have raised the money issue. Let me, again, emphasize the ECB has an amazing group of monetary analysts who, you know, it's actually one of the most interesting parts of my job is to receive the fantastic internal analysis of monetary aggregates. It's a very strong part of what we do. But what we do have, it remains the case that in our strategy review, we concluded it's important for inflation prediction to have it. Under some scenarios, monetary aggregates add on top, you know, it improves forecasting power on top of other things. But it's also the case that many times it's been a bad predictor. So I do think this surge in monetary aggregates during the pandemic, honestly, I really don't think has played a super important role in what's happened. We have had an inflation shock. The inflation did not come out of some consumption boom in Europe because people had too much money in their pocket. It came out of the global pandemic, which led to this imbalance between demand and supply. It came from, then there was the energy leg of it. And so in terms of the origin of the shock, I really don't think there was a monetary component. In terms of making sure the shock goes away, monetary policy has the lead role. But in terms of why did inflation go to 10, again, I really will take the stand of I don't think monetary policy was the originator of that.
Okay, maybe some brief remarks by Monika and by Mike, or answers.
Yeah, just briefly on this issue on why did the ECB ditch the forward guidance principle. I mean, my take on it always has been that in extraordinary times, that is during the times when monetary policy was not normal, when the ECB was effectively maintaining interest rates at the zero lower bound. So the interest rate tool couldn't really be used in order to affect or manipulate aggregate demand. It needed to rely on managing expectations, and that's exactly what it did. But as the monetary policy stand has been moved towards a more normal situation, there's less of a need for that. That has been my take on it. I'm going to skip question 2 because I think Philip has already addressed it in detail. In response to Mr. Bordo, I fully agree with you that it's difficult to understand why real interest rates effectively are still negative in times when monetary policy ought to be seriously tightened. So that's indicative of there being a clear need of further interest rate hikes. Question number 5 on why aren't monetary policy and fiscal policy better coordinated? They complement, they should be better coordinated. Yes and no. Let's not forget that monetary policy really ought, I mean, the ECB ought to be independent because it's in charge of maintaining price stability, okay? in a sense, irrespective of what national governments do. Having said that, obviously, those agencies need to talk to each other, and if they don't, we are seeing perverse outcomes, and I'm just going to enlist two. I had on my slides, I talked about this EU recovery fund that was launched in May 2021 for very good reasons, but I think it was super unfortunate that this PEP program was launched 14 months earlier. Yeah? It would have been better also for the inflation if PEP had been launched later, or if that recovery fund had been brought about a year earlier. Would have been better to coordinate right here. Second perverse observation that I have is, and I guess you all have made your own experiences. I live in Austria, and the Austrian government has launched a sequence of relief programs to relieve private agents from the negative consequences of inflation. So they're paying me back fixed amount of money, and I really don't think they should do this, because they are not in charge of fighting inflation, it's the ECB. I view this as a perverse outcome that has happened across the euro area. Thanks.
Yeah, I want to get to the question raised over there. I mean, I think the question was a really good one. If I look at the U.S., it was fiscal. It really was fiscal. It was a fiscal dominant, okay, policy that was accommodated by the central bank. Okay, John Cochrane calls it a helicopter dropping, but that is the key source of the excess aggregate demand, and it's manifested in negative real rates and a gap in the Taylor rule. Europe's a little more complicated because the supply shocks are bigger and you're not supposed to accommodate them, but there's still excess demand, and the excess demand was both fiscal and monetary, and you see it in that huge negative real interest rate and the huge gap in the Taylor rules. So it's like this is a big problem that's still left over.
Okay, I think we need to stop here. We're used up the extra time we had. I know some people on the left are going to be upset because I didn't call them, but I'm going to ask Michael Krause, the chair, in the afternoon to start the open round of questions here, and maybe some of those will fit. So please join me in a round of applause for our speakers.